Here's the thing. Most people assume rich people avoid taxes by cheating. Offshore accounts, shady loopholes, hidden money. But then you see a headline that makes no sense. A billionaire's wealth increases by billions of dollars, and they legally pay little to no income tax. So the question isn't, are they breaking the law? It's, how is this allowed? Because here's what most people don't realize. The biggest tax advantages used by the ultra-rich aren't hidden. They aren't secret tricks. They're written directly into tax law. They're legal. They're intentional. And most people never use them. Not because they're forbidden, but because the system wasn't designed for how normal people earn money. Most people think taxes are based on how much money you have. They're not. Taxes are based on how money shows up. That single idea explains almost everything. If money shows up as a paycheck, it's taxed immediately. If it shows up as business income, it's taxed differently. If it shows up as asset growth, it may not be taxed at all. Yet, the tax code isn't a moral document. It's an instruction manual, and the ultra-rich follow it exactly as written. So let's walk through 4 legal tax strategies, starting from the most basic idea most people misunderstand, and slowly working toward the one that explains how massive wealth compounds across generations. 4. Capital gains versus income. We start here because this is the denominator. Everything else builds on this distinction. Most people earn money like this. You work, you get paid. Taxes are taken out automatically. That's ordinary income. In many countries, high earners can lose 30 to 50% of that money to income taxes, payroll taxes, and state or local taxes combined. But the ultra-rich don't primarily earn money from salaries. They earn money from assets, stocks, businesses, real estate, equity stakes, and those assets can increase in value without triggering taxes. That increase is called a capital gain. Here's the key difference most people never learn. Income is taxed when you earn it. Capital gains are taxed when you realize them. If you never sell the asset, you never realize the gain. Think about it like this. You buy a house for $200,000. 10 years later, it's worth $1 million. On paper, you're $800,000 richer. But unless you sell the house, the tax system treats that gain as theoretical. No sale means no taxable event. This is where people usually stop and say, okay, but you still need money to live. Exactly, and that's where the next strategy comes in. 3. Buy, borrow, die. This phrase sounds dramatic, but the logic is surprisingly simple. Step 1. Buy. The ultra-rich buy assets that grow over time. They're not trying to cash out quickly. They're trying to accumulate ownership. Step 2. Borrow. Instead of selling assets to fund their lifestyle, they borrow against them. Banks love this. If someone owns billions in stable assets, lending to them is extremely low risk. So a bank might say, we'll lend you $100 million at 2 or 3% interest. Here's the crucial detail. Loans are not income. Borrowed money is not taxed. So now, someone can live on borrowed cash while their assets continue growing. Let's use simple numbers. Someone owns $1 billion in assets. Those assets grow at 8% per year. That's $80 million. They borrowed $20 million to live on. They might pay $500,000 to $700,000 in interest. Their wealth still grows far faster than the cost of borrowing. No income, no asset sale, no income tax. And then comes the final step. Step 3. Die. This is uncomfortable to talk about, but it matters, because death triggers the next rule. 2. Stepped up basis. This is where most people realize how deep the system goes. Let's go back to the earlier example. An asset is bought for $200,000. Over time, it grows to $1 million. That's an $800,000 gain. If the owner sells while alive, capital gains tax applies. But if the owner never sells and instead passes the asset to their heirs, The tax system resets the starting value. The new basis becomes $1 million. That $800,000 gain effectively disappears for tax purposes. The heirs can sell immediately and owe little to no capital gains tax. This is what people mean when they say death resets the tax clock. Now, you might be thinking, surely this only helps families that are already rich. Correct. And that's the point. This rule exists largely to prevent heirs from being forced to sell family businesses or farms just to pay taxes. But when applied to massive portfolios, it becomes a generational wealth accelerator. According to US Treasury estimates, stepped-up basis costs the government tens of billions of dollars every year in lost tax revenue. But it's still there, still legal, still used. And it gets even more interesting when we talk about how some people turn tax avoidance into tax deductions. 1. Charitable structures. Giving money away without really giving it away. This is the one that surprises people the most. Because on the surface, it looks like generosity, and sometimes it truly is. But the structure itself is incredibly powerful. Let's talk about charitable trusts and foundations. Here's a simplified example. Imagine you own stock worth $10 million. You originally bought it for $1 million. If you sell it, you trigger a $9 million capital gain. You owe capital gains tax. But instead, you donate that stock to a charitable foundation or trust that you control. Now look at what happens. You receive a charitable tax deduction. The foundation sells the stock tax-free. The money can be reinvested inside the foundation. Depending on how it's structured, you may receive income from it. Your family may work for the foundation. You decide how and when the money is distributed. There are rules. This isn't unlimited, but it allows wealthy individuals to avoid capital gains tax, reduce income taxes, retain influence over large pools of money. This is why ultra-wealthy families often have foundations that last generations. It's not just philanthropy, it's tax strategy plus legacy control. Here's what most people don't realize. The tax system actively rewards behaviors it wants to encourage: long-term investing, charitable giving, and asset ownership. The ultra-rich simply have the scale and patience to extract the maximum benefit from those rewards. Why this feels unfair, and why it persists. Now, you might be thinking, okay, but why can't normal people do this? Technically, some of these strategies are available to anyone, but practically they require large asset bases, long time horizons, access to elite financial advice, the ability to not need immediate cash. Most people live paycheck to paycheck. They can't avoid selling assets. They can't borrow millions at low interest. They can't wait decades for tax advantages to compound. So the system ends up taxing activity more heavily than ownership. Work is visible. Movement is visible. Liquidity is visible. Ownership isn't. This isn't about loopholes as mistakes. It's about a tax system built around incentives. Incentives that disproportionately benefit people who already own assets. The big reframing. So the takeaway isn't the rich are cheating. It's this. Taxes punish movement, not mass. They hit flow, not stock. If your money has to move, paychecks, bills, sales, you're visible to the tax system. If your money can sit, grow, and be quietly leveraged, it can remain largely untouched. Once you see this, headlines about billionaires paying low taxes stop being shocking. They become predictable. And the real shift isn't anger, it's understanding. Because once you understand how the system works, you stop arguing with it and start thinking differently about money, ownership, and long-term strategy. If this changed how you think about taxes, leave a comment with the part that surprised you most, or a system you've always wanted explained. And if you want more breakdowns like this, about the hidden rules behind everyday systems, subscribe.